the economy. It feels just impossibly complex, doesn't it? But what if it isn't? What if, like legendary investor Ray Dalio says, it's all just a simple machine? I mean, a huge one for sure, but one that's made of just a few simple, repeatable parts. So today, we're gonna pop the hood and see what really makes this thing tick.
There are a few things that get it going, like productivity. But this machine is really fueled by one single powerful and, often misunderstood idea. It's the one thing that dictates the economy's incredible booms and its spectacular busts.
And that one thing is credit. It's the simple idea that you can spend money you don't actually have yet, basically by borrowing from your future self. And get this, most of what we think of as money in the economy today, we're talking about $50 trillion in the US alone, is actually credit. Understanding that is so important because as soon as credit is created, it kicks off this totally predictable chain of events. So to really see how it all works, we need to go back, way back to the beginning. All right, so let's jump in the time machine. We're going back to the origin story of the institutions that create and manage all this credit. Banks. And you know what? They weren't invented to be complicated. Nope, they were created to solve a very simple and frankly, very annoying problem. Okay, so picture this. You're a merchant back in 11th century Italy. You're right at the heart of European trade, trying to do business, but you're just drowning in different currencies. I mean, in the city of Pisa alone, you had to deal with 7 different types of coins. It was a mess, inefficient, and super risky. So these clever money exchangers set up shop on benches, or banco in Italian, to streamline the whole thing. And just like that, the modern bank was born out of the need for a trusted middleman.
And the original business model? It was beautifully simple. At its core, a bank is really just a risk management business. It takes in deposits from people who want to save, and it pays them a little bit of interest for keeping their money safe. Then it turns around and lends that exact same money out to borrowers at a much higher interest rate. That difference, that gap, that's called the spread. And that is how the bank makes its money. It's all about connecting people with spare cash to people who want to use it.
And this simple idea of lending and borrowing? Well, this is what unleashes the most powerful force in the short-term economy. This is where that simple machine we talked about goes into absolute overdrive. And here's where it gets really interesting. This whole thing creates a powerful feedback loop. See, when you get a loan, you can spend more money. And remember, every single dollar you spend is a dollar someone else earns. So your spending literally increases their income. Now that person with their higher income looks a lot more trustworthy to a bank, so the bank is willing to lend them more money. It's this self-reinforcing pattern, and it's what drives economic growth and creates cycles. This is the key to understanding why these cycles even exist. In an economy with no credit, the only way to grow is to become more productive. That's it. Simple. But with credit, you can literally pull spending forward from the future. You can spend more than you produce today, but that creates a time in the future where you have to spend less than you produce to pay it all back. And that is what creates the debt cycles that we see over and over again.
But you know what they say, what goes up must come down. This cycle of borrowing can't go on forever. Eventually, that debt burden just gets too heavy, the cycle slams into reverse, and the whole machine threatens to crash. This led to the creation of institutions designed to be the economy's mechanics.
And the most famous recent example of this is, of course, the 2008 financial crisis. After decades of debt rising way faster than income, the debt burdens just got too big to handle. That self-reinforcing cycle went into reverse, and it started feeding on itself on the way down. And the fallout was just staggering. We're talking hundreds of billions of dollars in wealth that just vanished. And it wasn't just a problem in the US, it set off a global banking crisis. Millions of people lost their jobs, their savings. It was a really harsh reminder of just how volatile this credit machine can be. So this brings up a huge question. If these cycles are basically inevitable, thanks to human nature, how do you manage them? Who's the operator of this economic machine, the one responsible for keeping it from flying apart? Well, the answer is the central bank. The central bank's main job is to conduct something called monetary policy. The best way to think of it is like their control panel for the whole economy. By using a few key tools, they can influence interest rates, which either encourages or discourages us from borrowing and spending. They can basically speed up or slow down the machine. So what are these tools? Well, the main one is the repo rate. That's basically the interest rate the central bank charges commercial banks. Then you have things called reserve requirements. Think of these as rules that force banks to keep a certain percentage of their cash locked away, so they can't lend out every single dollar that comes in.
It's kind of like putting a governor on an engine to keep it from redlining.
And the effect is pretty direct. When the central bank raises rates, borrowing gets more expensive. So people and businesses borrow less, there's less cash floating around, demand falls, and inflation cools down. But when they lower rates, borrowing is cheap, more money flows into the economy, demand rises, and growth gets a boost. It's this constant, delicate balancing act.
Okay, so we get the machine and we get the operators. Now let's look at the actual players on the field today. In a market like India, the banking world is really dominated by two types of players. You've got the government-owned public sector banks, and you've got the private banks. And the competition between them tells a really fascinating story.
So first, let's talk about asset quality, which is really just a fancy way of asking how good are these banks at getting their money back. A key thing to look at here is the non-performing asset, or NPA. That's just a term for a loan that isn't being paid back. And historically, public sector banks have had a much, much higher percentage of these bad loans. We're talking more than double their private counterparts.
And that big difference in loan quality? Oh yeah, it hits the bottom line, hard. The top 3 private banks, when you put them together, earn over double the profit of the top 3 public banks. And why is that? Well, they often operate with fewer restrictions, they're usually more focused on tech, and they can be a bit more aggressive. It all adds up.
But here is the most telling part of the story: market capitalization. Basically, this is what the stock market thinks these banks are actually worth. And even though public banks had a 30-year head start, the private banks have just surged ahead. If you take out the State Bank of India, no other public bank even comes close to the massive valuations of giants like HDFC or ICICI. It's a huge shift in investor confidence and who really dominates the market. So it really seems like the private banking model is winning the current game. But the game itself is changing. The traditional banking system is facing this huge wave of new challengers that are rethinking the entire idea of finance. And these new models are gaining ground fast. You've got credit unions, which are more like cooperatives that care more about benefits for their members than just pure profit. You've got crowdfunding platforms where people can totally bypass banks and get money directly from a big group of small investors. And then there's microcredit, which has exploded into a multi-billion-dollar industry providing tiny loans that help people start businesses and escape poverty. Which leaves us with this one last thought. Banking was created way back in 11th century Italy to solve a specific problem of too many currencies and risky trade. The new models we're seeing today are all designed to solve new problems, like access, fairness, and efficiency. As technology and society keep changing, it really makes you wonder, what is the next great problem that our financial system is going to have to solve? And what will that solution even look like?